That's your money saying it's time for a McDonald's run. Because with new McValue at McDonald's, you get more than you expect. Like buy a 6-piece McNuggets and add a McChicken for just $1. Your money says let's go. Get more than you expect with new McValue. Prices and participation may vary. Valid for item of equal or lesser value.
Reality radio for a really great future. We're talking real money.
Today we start something brand new. It's talking real money every day. Well, every weekday. If I feel like it, I might do one on the weekends, but we're going to try doing talking real money, very short versions, on a daily basis. I am Don McDonald, one of the hosts of Talking Real Money, the longer version, and in these coming episodes, I will share with you things that I think are really important when it comes to dealing with money, particularly investing. And if you call our special 24/7 toll-free question line, I will answer questions too on the podcast. So give us a call, 855-935-TALK, 855-935-8255. And I would imagine you know what I'm going to talk about today. What in the world has been going on with the stock market over the last month or so? What's been going on is the stock market doing what the stock market is supposed to do. I'm serious. It's supposed to do this. In fact, I have a very important question for you to answer. Pay close attention. Did your investments lose money in 2018? Go ahead. Answer it. They did. Okay, good. Wait, yours didn't? Well, then you must be doing something wrong. What, you say? How can I be doing something wrong when I didn't lose money? Well, 2018 was the very worst year for stocks since 2008. Stocks across the board. Here, overseas, small, large, everybody got hit in 2018. And you say your investments didn't go down? You're doing something wrong. Because the only way you could have avoided losing money in 2018 was by either keeping everything in cash or you were just purely lucky. You just happened to get the right things at the right time. You couldn't possibly know the future. You know that, right? Both of those are terrible investing strategies. Let's say, and I'm just going to use an actual fund for argument's sake. Let's say you went and got Dimensional Fund's global 60/40 portfolio. It's a mutual fund. It's only available through select advisors. You can't go get it on your own. But the reason I use that is because it's global. It's 60/40. It's no load. It's low fee. And it's 60% stocks globally and 40% bonds globally. That fund last year, in calendar year 2018, lost right about 6.5%. All these numbers are according to Morningstar. How has it done on average, though, over the past decade since 2008? Well, its average annual return over those 10 years has been about 8% a year, over 8% a year on average. Not bad. You stuck with it. You did okay, even with that 6.5% loss, because that's through December 31st, 2018. Now, I totally get the fact that you wish for total safety. Totally understandable. Yet you end up actually losing money when you invest to avoid a loss. Because remember, if you invested in anything other than the shortest of short-term bonds, last year you lost money. Longer-term bonds lost money. Not much. Okay, I'll give you another example. The Vanguard Short-Term Treasury Fund. That's one of the least volatile mutual funds on the planet with some of the lowest fees, and it returned just over 1% per year over the past 10 years. But you didn't make money. You lost money because inflation has averaged more than 2% per year over that same period. So you lost about 1% per year, which is actually a bigger loss than you would have sustained in that 60/40 portfolio in just that 1 year, for just that 1 year. Bear in mind that negative 1% is compares with after inflation about a positive 6% for that 60-40 portfolio. Big difference. You can be too conservative. You can absolutely be too conservative. You have to have some stocks in your portfolio. It's essential. Let me add one more example. Let's use another dimensional funds portfolio again because it's global. They have a global portfolio. It's just a single mutual fund with 25% in stocks and 75% in bonds. It lost a bit under 2% in 2018. More conservative. And yet it still averaged almost 8% per year in returns over the decade. The trick is knowing how you need risk and how you tolerate risk. You should never take on more risk than you need to take, but you should never take on more risk than you're tolerant of. And that is a tough thing to figure out on your own. That's why scientists have been working for years to develop questions that get to the root of our risk tolerance. And we found a service that we purchased and that we provide to you at absolutely no cost and with no obligation. And we call it our Risk Quiz. We brand it with that, RISQUIZ. Take that. It doesn't cost you anything. You're not going to get bugged by anybody. And it'll give you an idea how much you can stand having in stocks and then figure out how much you need to put into stocks based on historical returns. Go check it out. Go take the Risk Quiz at TalkingRealMoney.com, TalkingRealMoney.com. And now I think it's a good time to take a call at 855-935-TALK, 855-935-8255.
Yeah, hi. My family had mutual funds with Solomon Smith Barney. My grandparents held the funds until my grandfather passed, and my grandmother took over, and my cousin was the executor, working with the mutual funds. And Solomon Smith Barney lost $250,000 or so. They lost, I think, $300,000 to $500,000 of our money, and nobody ever contacted anybody about what happened to that money. And I'm just wondering if there's any way to contact them, or it's been a long time. It's been actually more than 15 years, I believe. But this was back, I think, in early 2000, in that time frame, 2000 to 2005 or something like that. So Solomon Smith Barney for us, for my family. Thank you.
Wow. Solomon Smith Barney. I haven't heard that name in a long, long time. They were, many years ago, I can't remember when, they were merged into Morgan Stanley, which also took my old firm that I worked for back when before I recovered from being a stockbroker, which was Dean Witter. All of those things became part of this behemoth, which is Morgan Stanley. I'm not exactly sure what you're asking. If the account is still held with Morgan Stanley, the funds are probably going to be way different than they were back in the Solomon Smith Barney days. But if they are, you need to contact a broker at Morgan Stanley if you still have one there. Otherwise, if your question is, what can we do about the losses that were sustained many years ago? The answer is probably nothing. Probably nothing. Pretty close to nothing because, well, one, the firm's gone, and two, I would imagine the statute of limitations has run out on any claims you might have. However, if those funds still exist somewhere, whatever funds they are, I can assure you they're ridiculously expensive. You need to make some decisions and get those into something that has no loads and low fees and get you probably far better diversification than you have right now. I don't know what you have, but you need something far better. Can you do anything about what's happened in the past? Not very likely. But thanks for the call. And we'll do this again tomorrow on another daily edition of Talking Real Money. 855-935-TALK is the number. 855-935-8255. Call it 24 hours a day, 7 days a week. And remember, all of the things I talk about, all of the articles, Real Investing Journal, the Risk Quiz, all of these kinds of cool things are available to you anytime at our omnibus website, which is talkingrealmoney.com. We have classes you can attend there. We have shows, podcasts you can listen to, all kinds of good stuff. So check it out at talkingrealmoney.com. I'm Don McDonald, and thanks for joining me.
Talking Real Money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.